Let's get straight to the big issue, shall we? A new shock for global markets.
I'm particularly worried.
We don't know what's going on.
Investors are naturally quite panicked at the moment with the sell-off.
It's a very, very dark outlook.
Record low treasury yields.
The coronavirus challenge.
Now we have an oil shock. The plunge in prices, the oil prices.
There is a distinct possibility of a recession.
The global economy is back in a window of weakness.
We are not at the bottom yet. Central banks do not have the efficacy that they used to have.
The VIX is at the highest level since the global financial crisis.
It's definitely volatile. We need to, be looking at the fundamentals.
Opportunities at the stock level.
Sit and wait and be patient.
Rather than sort of the overall market.
Until we have a little bit more clarity and the fog of war is lifted.
Be careful out there.
It's going to be a bumpy ride.
Many questions to ask my panel this morning. Around the table with me in New York, joining me, Priya Misra of TD Securities, Nisha Patel of Parametric, and Kristen of Citi Private Bank. Ladies, great to have you with us. What a morning for it. Huge price action. Priya, can we begin with that bid in the bond market to see the whole curve just drag below 1%?
Sure. So I think we're dealing with a supply shock, now demand shock, now an oil price shock. I think the bull flattening in the Treasury curve is essentially the market, at least the rates market, is screaming for policy action. Now we're, I think, looking for Fed action, fiscal action. I mean, should the president be adding to the strategic petroleum reserves here? I think we kind of need help, coordinated help. I'm not sure about global. I think central banks are pretty limited in terms of what they can do. Now, I think the New York Fed actually did something pretty significant. They did come out with the one thing that they can do without requiring the board, without requiring essentially Congress, is increase the amount of repo operation. So I think what the Fed is telling you, if you need help on the balance sheet front for dealers, they're there. The problem is, we actually need something to offset the growth shock here, and I think we haven't seen anything so far. So I think the Treasury curve can actually continue to bull flat.
What do you think is the circuit breaker in a moment like this?
I think we need, number one, we need policymakers. I've often thought that, markets will continue to panic until policymakers start to panic. Now, we've seen the Fed panic. We haven't seen much from the administration. We haven't seen much from global policymakers. I think the moment they come out and say, well, we've got a plan, at least they can sort of stem the bleeding. Now, we have to look at the details. We don't have anything from the fiscal side.
This was my question to Larry Kudlow, the National Economic Council Director, this Friday that's just gone. Planning some things, great news. What's the threshold to deploy them? I have no clue. Do you, Nisha?
No idea. And I think the biggest issue is that even if there are some fiscal measures that are taken, even if the government comes out to do something, the virus which has come out of left field, that can only be solved one way. And I think in the short term, unfortunately, what will happen as more testing kits get out there, the count of the number of infected people is only going to go up. So you've already had kind of this major issue with the virus. You have the oil kind of price war going on with added fuel to it. And this is something that's outside of the control from the Fed and the government, I think, to some extent.
On a morning like this morning, the commodity market, Kristen, just takes over. And then we're talking about what is happening with the credit market a little bit later this morning as well. Equities are in the back seat right now, aren't they?
Yeah, because over the past 2 weeks, when we saw the sell-off in equities, credit markets were actually pretty orderly. So we saw the big movement in rates, but we even said this on Friday, looking at the spreads in high yield and investment grade, they weren't at levels where you all of a sudden say, it makes sense to take on this risk. Now what we're seeing with the movement in oil, I mean, this is unique because it's both a demand and a supply shock. So on the demand side, we can link that to economic growth and the virus. On the supply side, you can say it's within Saudi Arabia and Russia's control if they want to come back to the table. But in the meantime, what we're concerned about is the small and medium-sized mid-cap businesses where you do have, if we go back to 2016 and use that as a blueprint, that was about a 21% default rate in energy and high yield. And so on one hand, you could say that cleaned out some of those balance sheets, but I think we could see some pain here.
This, for me, is the real story right now. A lot of people will say, what are the different asset classes telling you? Actually, different asset classes have different characteristics. Right. You have equities, which is an anticipatory asset class, the hopes and dreams, if you have any left, over the next few years. In a commodity market, you clear supply and demand right now. That profile's not great. Bang. In a credit market, we go back to basics. Am I going to get paid when those coupons come due?
Right, exactly. I think default risk has been extremely low in the entire credit market. I think the question I was getting from clients is this V, is this U? And I think that was very premature. If you don't know how deep that trough is and you don't know how long it's going to last, it could easily be a U or an L. And I think the credit market's sort of waking up to that. So if default risk starts to get repriced, we've seen this in the fourth quarter of 2018, there's no liquidity in that market. There have been massive inflows. And so I think if I'm a credit investor, I'm trying to get out, I'm safe haven, it all ends up on dealer balance sheets. And unfortunately, the Fed doesn't have a system right now to provide to provide balance sheet against credit. It does against treasuries. So we need something like the TAF auctions. That's what I'm hoping from the Fed pretty soon, where they will help. You know, it's essentially giving the discount window to the market. The last time they did this was in 2008, where they realized that banks did not want to access the discount window. If the Fed comes to the market and says, here are loans against credit, I think that'll help. But still, it's not solving the fundamental, it's at least solving the liquidity.
The 08 parallels will worry a lot of people. I think it's worth pointing out that in terms of absolute levels that we're at right now, high yield spreads, things of that nature, nowhere near them. But in terms of the pace of the move, Priya, the pace of the move has been absolutely staggering.
Yes, and I think dealer balance sheets are much, much smaller today. The ability for that to increase is also much smaller. I think the market structure has changed significantly in the fixed income market. If everyone's trying to get out the exit, I don't think the Fed's going to wait until that same trigger, because we could get there, you know, very soon. Look at the pace in the Treasury market. I think that's going to tell you that pace of move we haven't seen really since the crisis. I think the Fed's going to be concerned about the pace. So you get another bad CDX IG day, I think they're dusting off a lot of those tools from 08.